Welcome to The Explainer. Today, we're diving into what I can only describe as an absolute structural earthquake happening in global finance. Seriously, this is a shift so massive that it's fundamentally rewriting the rules of wealth, power, and reserve management right before our eyes. But the kind of strange thing is, a lot of traditional investors are just completely misreading it. So today, we're going to follow the data to uncover exactly what's happening, why the smartest money in the world is acting so unexpectedly, and what it all means for the future of your money. I want to kick off our investigation right here with this jaw-dropping number, $5,405. Yeah, you heard that right. That was the price for just 1 ounce of gold in early 2026. Within a single calendar year, from January 2025 to January 2026, the price essentially doubled. It's wild to think about, but the US dollar's ability to buy gold was literally cut in half in just 12 months. Now, normally when the price of an asset skyrockets like that, you'd totally expect buyers to, take a breath, step back, and wait for things to cool down. But that is absolutely not what's happening here. Okay, let's dive into this because the paradox we're seeing is just striking. In the first quarter of 2026 alone, central banks went out and scooped up a staggering net 244 metric tons of gold. To put that into perspective, that's a 17% jump from the previous quarter, making it the fastest pace of sovereign buying we've seen in over a year. I mean, basic economics 101 tells us that when prices go up, demand is supposed to go down, right? But instead, sovereign reserve managers, literally the most calculating, risk-averse buyers on the planet, are hitting the gas pedal. Which naturally brings us to the big fundamental question. Why on earth is the smartest money ignoring the basic rules of supply and demand? Well, if central banks aren't price-sensitive anymore, it means their entire motivation has shifted. They aren't looking at some quick quarterly profit and loss sheet. They're repositioning massive sovereign balance sheets to manage decade-long systemic risks. So let's treat this like a real investigation and uncover the hidden motives driving this massive, totally counterintuitive anomaly. Now, you might be wondering just how big this shift really is. Look at these two numbers. They're practically identical. We've got $3.909 trillion in global official gold holdings, right up against $3.920 trillion in foreign official U.S. Treasury holdings. For the very first time since way back in 1996, official gold has effectively reached parity with U.S. Treasuries, which, let's be honest, has always been the ultimate fiat asset. As you can see from this quote drawn straight from recent economic research, this parity is historic. We're not just looking at a fluke or some weird temporary market glitch here. Actually, scratch that. It's a massive structural transition in how the whole world chooses to store value. For decades, the US dollar and treasuries were the undisputed kings of international finance. But today, that crown is looking a little heavy. To really grasp how we got here, we have to look at the timeline of the weaponized dollar. And just to be clear, in this explainer, we're looking at this purely impartially from a risk management perspective, because that's exactly how central bankers are seeing it. It started after the 2008 financial crisis with massive money printing. Then, global geopolitical fractures started deepening. But the real game changer was 2022, when Russian sovereign assets held in Western banks were frozen. For non-aligned countries watching from the sidelines, the takeaway was crystal clear. Holding your dollars in somebody else's bank carries a huge confiscation risk if things get politically tense. That terrified a lot of reserve managers, sending them running for assets with zero counterparty risk. But hey, it's not all just about geopolitics. There are three major structural forces fueling this gold rush. First, fiat currencies everywhere are losing their purchasing power. It's a global trend, not just a dollar thing. Second, as we just talked about, keeping your reserves in foreign custody is suddenly looking super vulnerable. Holding physical gold inside your own borders completely wipes out that risk. And third, the classic 60-40 stock and bond portfolio, it's kind of breaking down. With stocks and bonds moving in the same direction lately because of inflation, bonds just aren't the safety net they used to be. So central banks are finding a new anchor. And this brilliantly illustrates just how crazy this reversal is. Look at the shift between these two eras. Back between 2002 and 2008, we were in a massive selling era. Western European central banks were basically dumping an average of 591 tons of gold every single year. But fast forward past 2009, and the whole script flips. We entered this massive buying era, averaging over 404 tons of accumulation a year, driven almost entirely by emerging markets in the global south. So let's look at the usual suspects in our investigation. Who is actually doing all this buying? Well, Russia and China are absolutely leading the pack, having scooped up roughly 1,800 and 1,900 tons each. Then you've got Turkey and India following pretty closely. Now, these specific countries represent a geopolitical bloc that is aggressively accelerating its strategic independence. They're making sure their economies are insulated from external shocks and aren't totally reliant on Western financial systems.
And the data doesn't lie. This IMF data perfectly captures that structural move away from dollar dominance. But here is the really fascinating part. These official numbers, they are probably way too low. There's this whole unreported demand layer. Countries like China will often go months without reporting anything, while quietly hoarding massive amounts of gold off the official books. When you factor in that shadowy hidden layer, the global squeeze on physical gold is even tighter than anyone is letting on.
Now, if you're sitting there thinking this is just a BRICS phenomenon, think again. Just look at Poland and Uzbekistan. Poland literally announced a public target to hit 700 tons in total reserves, and they are buying at breakneck speeds, like 31 tons just in the first quarter of 2026 alone. Meanwhile, Uzbekistan is quietly pulling a genius move. They're leveraging their own massive domestic gold mines to structurally convert their natural resources directly into sovereign wealth without anyone really notice it.
Okay, let's pivot for a second from all the geopolitical drama to the hardcore math. Why gold, and why right now? It all boils down to its job as a safe haven asset. That's an investment that holds or grows its value when the rest of the market is on fire. But here's the catch. For the longest time, economists actually struggled to prove this with standard linear math. The old models just made gold look totally erratic.
So the crucial point was recently cracked by some dense academic research using a super advanced method called quantile-on-quantile regression. Now, please don't let the jargon scare you. Put simply, instead of just looking at average market days, this math maps out how gold behaves across every possible market extreme. Think of it like a doctor using a full-body MRI instead of a blurry, basic X-ray. It finally gives us the whole picture. And the so what of all that complex math is this incredibly distinct U-shaped curve. It turns out during boring, everyday market conditions, gold basically just sleeps. It doesn't do much. But when things get extreme, it acts like a superhero. During terrifying stock market crashes, gold spikes. And fascinatingly, it also surges during those face-melting extreme bull markets. It's literally the ultimate asymmetric insurance policy.
As the researchers concluded, gold responds to the market selectively. This completely proves that these sovereign buyers aren't just blindly hoarding shiny rocks. They know exactly what they're doing. They're buying a highly specialized regime-dependent insurance policy that flips on precisely when fiat systems undergo extreme stress.
And that is exactly why, even at a staggering $5,405 an ounce, institutional demand isn't slowing down for a second. A recent survey showed that nearly 40% of reserve managers plan to increase their gold holdings over 2026. No way, right? But they are telling us point blank, the price tag doesn't matter. They're trying to survive decades of systemic risk, not score a quick quarterly bonus.
Because of all this, the way regular, everyday people are using gold is completely inverting. Look at this demand shift from early 2026. Making gold jewelry, which used to be the absolute biggest driver of physical demand, is down 23%. But at the exact same time, people buying physical gold bars and coins has exploded, up 42% year over year. Especially in Asia, we are seeing gold rapidly transition away from just being something pretty aware into a primary, hardcore monetary savings instrument. Now, I want to be super clear here. When we talk about de-dollarization, it's vital to look at what the data is actually saying, free from any bias. For most countries around the globe, this isn't some angry ideological war to dethrone the US dollar. It's just orthodox conservative portfolio logic. They want historical stability, they want assets that perform during a crisis, and they desperately want something with zero default risk. Honestly, it's just pragmatic diversification.
So, let's bring this all together. Central bank reserve managers are arguably the most sophisticated macro players on the board. They have access to the absolute best geopolitical intelligence on Earth. So, when they collectively mash the buy button on a single hard asset, completely ignoring record-high prices, that is a massive systemic signal. They're showing us exactly what they believe about the future of fiat money. The entire international monetary system is transitioning as we speak. It's becoming more pluralistic, and that absolute, unquestioned dominance of the dollar, it's cracking. Central banks have already done the math, and they are preparing for a new reality. Which leaves us with one final, pretty provocative question to chew on. If the smartest, most risk-averse money on Earth is preparing for a massive structural shift, is your portfolio ready for a world where the dollar isn't king? Thanks for joining me on this explainer, and keep questioning the data.